and welcome to another episode of Talking Trust. Today I'm sitting down with Richard Staveley, manager of Rockwood Strategic, to talk about investing in the UK small cap sector. Richard, thanks for joining us today. Could you start off by providing an overview of the trust's objectives and also its current portfolio?
Sure, Joe. Rockwood is trying to capture the investment opportunity for companies that are capitalised under £250 million on the London Stock Exchange, of which there are not many other participants these days that look down into that part of the market. We're looking to find companies that we think can double in value over a 3 to 5 year time frame. And the way the maths works is that if they double over 5 years, you make about 15% a year internal rate of return. So that's our sort of target performance. The types of companies that we're predominantly looking for are ones that can benefit from either strategic, operational or management change or initiatives to try and unlock or catalyze the value that we see in those businesses. We are out-and-out value investors, so that's important to us too. In terms of the portfolio, we run a concentrated approach. We currently have 20 holdings, although we expect to have a bit more in time. We had a few more, but we've had a number of takeovers and have taken us back. But we expect to have a what we call core holdings of about 7 to 10, of which we've currently got 7. And then we have our springboard and opportunity holdings, which we look to have 10 to 20. We've currently got 13 of those. In terms of sectors, we don't spend huge amounts of time worrying about our exact sector exposures because we don't have a benchmark per se. We're targeting absolute returns. And we have quite a wide dispersion actually as it is. We use common sense to make sure we're not all in on a particular industry. At the moment, our largest sector position is actually industrials at 21% of the portfolio. And then we have 17% in media companies, and then both at 14% is technology and construction.
So how would you say that Rockwood differentiates itself from its peers in terms of portfolio concentration, but also the typical market cap of companies that you invest in?
Well, Joe, we do see ourselves as pretty differentiated. Most of the UK small cap markets have taken on James Maynard Keynes's quote that it's better to fail conventionally than succeed unconventionally. So we are relatively unconventional in our approach. We're very concentrated. The 20 holdings that we have compares to most UK smaller companies funds with 40, 50, 60, 70, some over 100 holdings. That's mainly to do with the fact that a number of those fund managers also run open-ended funds, and open-ended funds require daily liquidity. And as a result, they don't really like to have to be as concentrated as that. The concentration effect means that we tend to take stakes in the companies, and we actively look to do that within Rockwood. For our core holdings, we seek to have at least 5% of the company, which would allow us to call an EGM of all the shareholders on the matters which we think the company should be taking more seriously if they choose not to. And I think in relation to that, we do engage with the companies that we invest in on a much more active basis than your typical smaller companies fund. In terms of market caps, most of the sector are benchmarked against the Numis, we're now called the Deutsche Numis Index, which is the bottom 10% of the market. But because of the structure of the UK market now, that index has changed quite a lot. And as a result, it has quite a lot of FTSE 250 mid-cap companies in it. And if you look at the managers that benchmark themselves against that, they tend to end up owning quite a lot of FTSE 250 companies and companies that are £1 billion market caps. Our top core holdings are all sub 150 million market cap, right down the bottom of the market where very few other participants are looking. And I think in that regard, we differentiate ourselves further in that we actually have this strong value bias and a tendency to back recovery situations, which even for those few fund managers that look down in the microcap space, they tend to want to look for growth companies. So we're differentiated like that too.
Could you talk us through your investment approach in terms of how you assess value and also what attributes you look for in a potential company?
Sure. So Warren Buffett said that price is what you pay, value is what you get. And when I was younger, I didn't really understand what he meant by that. But what he's essentially saying is that markets are regularly inefficient. The price of a share doesn't really reflect very regularly the value that business really has. Buffett had this whole, when he bought a share, he looked at it as if he was buying up the whole business, that kind of mentality of buying the whole business rather than just a fractional ownership of a share that trades on a stock market. And that's something that we think about very closely when we're considering value. Now, value in itself is really the future free cash flows that a business can generate. So we're very free cash flow focused. We typically buy things, though, when their free cash flow generation may be a bit poor or has been depressed for either external or internal reasons. And thus the market tends to be quite myopic and short term and sort of value the business off the current or near term depressed levels of free cash flow generation rather than its long term free cash flow generation potential. So that's how we think about value. In that regard, we often actually bias a lot of our valuation thinking to the EV to sales ratio, which looks at a company's market cap and debt structure relative to the level of sales that it has in the business, rather than being very focused on the exact level of profitability in the next year or two. Why we do that is because we love businesses that have loads of sales, but for some reason there's not much profit coming out of the bottom, because the market tends to look at the profit number rather than the potential that the sales could produce. We also think very carefully about what other value might be hidden within the business, not just what's in public view. And that might be as much things like, tax losses, where that cash flow can be accelerated because they're not having to pay as much tax because of bringing forward tax losses, or hidden assets that within the business. Sometimes the value is in plain view. It really is assets that if they were sold, then they would really demonstrate the value in the business, leaving whatever's left behind as to be valued more fairly by the stock market. In terms of attributes, we are looking for businesses that can benefit from those sorts of strategic decisions or management change, or indeed operational improvements that can happen to turn around those businesses. And that's what we look for to catalyze change within the business and essentially mean revert profitability. My favorite stocks are stocks that used to make 10% profit margins, now make 5%, everyone's given up on them. And then if you get the right people involved, get the business refocused, they can get themselves back up to 10% profit margins. That in itself, if the sales don't change at all, would mean that you double the level of profitability in the company. And often when the point that they're at that depressed level, the multiple paid is low. When they get back to a normal level of profitability, you get a high multiple. So that's what the kind of attributes we're looking for in the stocks that we buy in Rockwood.
And that brings me neatly on to my next question, which is whether you have an exit plan in place when you're looking at investing in a company.
Well, that would be good, wouldn't it? But the reality is, Mike Tyson said, plans are very good until you get punched in the face. So having a plan is difficult. Having options is something we take a lot of time thinking about for Rockwood stocks when we buy them in the first instance. Of course, because we're buying relatively illiquid positions and we're buying big stakes. So we need to know how we're going to exit that holding or what the likely options are going to be down the line. And a lot of fund managers think less about that, we would suggest, than we do, but we do put a lot of work into that. Now, that may involve strategic buyers. It may be due diligencing what trade buyers might benefit from owning the business once it's been sorted out and stabilized, or when the profitability has been recovered. It might be whether the business itself has attractions to private equity participants, because maybe they're consolidating in that particular sector, or the characteristics of the company. Usually for us, it's the prodigious free cash flow generation, which private equity are attracted to. So we think about those options. Now, we can't rely on them, but once you've got an idea, whether that's going to be the case. We also spend time, importantly, thinking what might stop an exit. And that's things like some businesses have large pension fund schemes, which puts off private equity. There may be aspects to their business that are going to put off certain trade buyers. So we think quite carefully about what might be a kind of poison pill that might frustrate us at the end of the process. I must stress that Rockwood should not be seen as a strategy that's like permanently scouring the market for takeover targets. We're scouring the market for companies that we think can materially improve shareholder value and recover profitability and over the 3 to 5 year period. But then after that 3 to 5 year period, we think very carefully about, who might want to own that asset afterwards if the stock market isn't interested in taking it on to the next stage or the next size of business.
What parts of the market do you find most interesting at the moment?
Well, I'm often asked this question actually, and we are so stock specific in terms of how we see things. We just don't kind of get sort of really into a particular sector. It's usually a particular stock. I would say though, to try and be as helpful as possible, the smallest companies, the smallest of the small, it is definitely the most interesting area because so much capital has flown up the market cap spectrum within the UK small cap world, and institutions are not looking down at the bottom. That's where we do think the biggest anomalies are. And the long-term data actually just proves that out. If you look at the data, the bottom 2% of the index versus the bottom 10% of the market since 1955, there is a massive premium for the smallest of the small. That said, in terms of where we are in the world at the moment, there is clearly some sectors and parts of some industries that have got external pressures that are finding it difficult. So if I was to narrow it down, some of the most interesting areas of the market are where there's external pressures as well as the internal pressures that we're identifying. So you double up with both problems internally and externally. And then if you can have confidence those external situations maybe just cyclical or will abate as alongside changing the management or changing the strategy or changing something else to improve the business, that's where you can get some real excitement.
Thanks to the attractive valuations on offer, the UK small cap sector has been a fertile hunting ground of late, particularly for overseas acquirers, and M&A has been a key theme of your portfolio with 6 bids for your companies in 2023. Could you talk us through some of those transactions and also whether you believe that M&A will continue to be a key theme in the year ahead?
Sure. Okay. So I think let's take the second part first. 2024, I absolutely think there's going to be a lot more M&A. There may actually be more than 2023 because private equity, although there were some private equity deals, was relatively quiet in 2023 relative to 24. And I think in particular, private equity are sitting on record amounts of dry powder, which not all of which will go into public markets, but a good chunk should find its way into public markets. And why shouldn't it? The reality, as you said, the valuations are very low. And if you think about the private equity model of returns, how they build up their return profile for their funds, part is the starting valuation. That's clearly a lot lower than it has been in the last few years. Part of it is leverage. That's what's really taken the kind of volume of deals out, or one of the contributing factors at least, because it's been slightly more difficult credit markets and the cost of debt's been higher. But actually that looks sort of set to start to ease, we would expect in 2024. And for those private equity houses that know that the interest rate cycle will probably start to decline either during 24 to some greater or lesser extent, or might start to think about the refinance options that you might have during your holding period of a business that you purchased now. So we think private equity transactions will pick up. At the same time, strategic and trade buyers are indeed scouring the UK market, and we did have good success last year, as we have in previous years, of spotting things or at least backing companies that end up being attractive to other participants. I think to try and select maybe 2 or 3 of the ones that we had that are of interest. I think onthemarket.com is a fascinating situation. Everyone probably has heard of the brand, much smaller than Rightmove, the market leader. But little old onthemarket.com valued at 50 million quid in the middle of last year, and but it was becoming very cash generative, profitable, had net cash. in a market that really only has one very dominant leader. And, the bid came in at a 98% premium to the 3-month average for that stock. And who did it come in from? It came in from CoStar, a NASDAQ-listed company worth over $25 billion. And I think this is really, for me, encapsulates the sort of strangeness of the UK equity market now. If other professional and non-professional investors aren't going to bother looking at these companies, then there are other people that are motivated to do that. We have secured a 93% IRR in our onthemarket.com investment. And as I said earlier in the interview, we were just targeting 15% a year. So that's an absolute belter for Rockwood shareholders. The second one would be, City Pub Company. The chain of about 50 pubs that have been created by Clive Watson in the UK, primarily freehold. And Clive has been, as has the rest of his board, been telling shareholders and non-shareholders and anyone that would listen that they'd had the estate independently valued at £160 million. And the shares were day-to-day valued at £95 million. And we kept buying more and more shares in that business. And lo and behold, in this instance, a trade buyer, Youngs & Co., the well-known and long-standing part family-owned pub company, dominated in the south and southeast. And Youngs are a very, very well-run business, really understand value in their sector, and will be a perfect owner for the City Pub Group estate. They bid over nearly a 50% premium to the shares, and we're going to secure about a 48% IRR in that one. I'm very pleased we are with that. The final one was actually private equity, which was Finsbury Foods, the cake manufacturer for the mainstream supermarkets, and also makes bread rolls for people like KFC. I loved it because the chairman of Finsbury Foods, his name was Peter Baker, which you couldn't really make up, could you? But Finsbury was bid successfully for by DBay, who are a private equity firm. And it was a slightly lower bid than we would have wanted. We thought the business was worth a bit more, but at the end of the day, overall shareholders voted it through, and we secured in that instance, double our target returns, an IRR of about 33%.
So one last question for you. What are your views on the outlook for UK small caps in the next year and possibly beyond?
Well, Joe, you're being a bit unfair here, because actually 1 year predictions are for sort of talking heads on CNBC. It's very difficult to have genuine confidence on what market's going to do on a 1 year view. But I would say that over the next 3 years, markets are very likely to be, decently higher, particularly the UK market. We would have thought in UK small cap over those 3 years. Sir John Templeton, one of the greatest investors, he said that bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. And when I sort of read the press, speak to people down the pub, or anyone, in fact, that will listen, they don't feel very euphoric about the outlook for UK equities, nor do they feel particularly optimistic to me. Some aren't even really skeptical. We definitely are pessimistic about the future for the UK stock market overall. And that's where they start. So all the upside is from where we start at this point. And what I would say in that regard is that what I've experienced during my 25-year career of investing in the UK, and also when I look at all the data from history in UK small companies, after difficult periods of performance like we've just had, the bounce backs are usually pretty aggressive. They also tend to last more than just a sort of flash in the pan. And why they last longer than that is that quite a lot of investors, possibly even the majority of the market, really only starts to react to the start of the bull market after the first period of strong performance. But you really need to capture the first bit to get all the compounding effects. So we would say this is a really exciting point. I think valuations, it's proven through all the academic research, are the primary or the largest a contributor to what future market returns are going to be. So if you buy a cheap market, your future return profile will be strong. And the UK stock market now, and I'm definitely not the first person to say this, is both absolutely cheap. It's definitely cheap versus its own history, and particularly cheap against overseas shares, because as everyone knows, in America, there are certain shares which are valued very highly right now. So our starting point is low valuations. Our starting point is negativity and pessimism and concern. And we would say that those are the right criteria for getting super excited. Now, the problem is that what's going to change all of this? Because you could have possibly said exactly the same thing, 6, 9, 12 months ago. And that's what sort of puts people off, because they think, I might as well just keep waiting. I'll wait till it starts moving. But I think we've actually had a very interesting period just in the last 6 months in markets. In the back end of last year, there was a bit of a strong market rally, both in UK small cap, but also just more widely. And it's when consensus reached a tipping point for about, I would say, probably 2 months, that said that when interest rates are going to start coming down. And there was a bit of a rally, lots of stocks were marked up, and you could almost see the buying panic in people's in stock prices, of people going, oh gosh, I need to move now, I need to act now. And then, quite rightly, in the early part of this year, people have realised that consensus that they're about to start coming down really quickly got slightly, they'd sort of run over their skis, basically. And for a number of reasons, notwithstanding the fact that wage inflation remains pretty sticky and pretty high. I mean, all the companies I keep meeting say they're putting it up by at least 4%. Well, that's not very helpful of hitting a 2% inflation target if everyone's putting their wages up by 4%. I think that Jeremy Hunt, much as he really respects the IMF, is probably going to ignore them with regards to his next budget, and probably throw quite a lot of money at the UK economy, which won't be disinflationary. It'll be an inflationary act of some sort. And thirdly, the very sad events in the Middle East, whether that's how the Houthis are affecting freight rates, or indeed the wider energy complex implications of what's going on in the Middle East, alongside what's happening in Russia, means that energy prices are sort of firming a bit as well. All this sort of means that the inflationary backdrop has actually got a little bit more difficult for it to continue to fall. Now, I do expect it to continue to fall throughout this year. I think it will happen. And I also, I'm happy to say, do expect interest rates to start falling during 2024. And I think that's all your listeners really need to know, because that will be positive for UK small cap. And really, in summary, for those that were slightly panicking at the end of last year, or hadn't panicked and worked out interest rates weren't going to start falling in the very start of this year, we are in the final phases of being able to position oneself to capture the impact that the start of falling interest rates will have on UK smaller companies' risk appetite and equity markets more generally. So I'm pretty excited about the 3-year outlook.
And that's a very positive note on which to end. Richard, thank you very much for joining us today.
Thank you so much, Jo.
If you'd like to learn more about the Trust, there's a wealth of information available on Rockwood's website, including Richard's quarterly investor presentations. We also hope you're able to join us for our live webinar event with Richard on the 4th of March. Information on this, plus our in-depth research on Rockwood, is available on the Kepler Trust Intelligence website. Thank you for watching today, and we hope you'll join us again soon.